Welcome to this Killick Explains video on the dilemma facing central banks. Now, this is a topic that I have covered in the past. A couple of years ago was the last time, but things have moved on quite considerably since then in 2022. So I'm going to start with what is their basic role. Now, if you look at the Bank of England, for example, it has been tasked with achieving two things. One is keeping inflation at or around a target number, 2% in the UK, using interest rates as the main weapon, one could argue, and the other one is maintaining financial stability. And the two naturally are connected. And we have an independent central bank which is making decisions about what to do next in relation to its mandate separately from the Treasury and government. Now, I just want to cover some basics here. I mean, why have an inflation target? Why actually set a number? And several people are questioning it as inflation storms way above the target number around the world right now. Well, it makes central bank policy visible and clear, is the logic. People know the mandate. It makes the bank accountable for hitting it. And also, as to why it's a small positive number, such as 2%, for example, well, a small amount of positive inflation is thought to be good for the overall economy. It means that shops, businesses, for example, can raise prices at a gradual rate. It means wages move up at a gradual rate. And the opposite, deflation, is not thought to be a good thing. It's thought to be associated with a contracting economy. So a small amount of positive inflation is thought to be something that a central bank should aim for. So what's gone wrong? And in 2022, things have gone badly wrong. They were going wrong before that, but certainly this year. We have inflation running into double digits, not just in the UK, but around the world. Goldman Sachs and Citigroup forecasting it could double next year, and the consensus being that it could easily hit 15% or so by 2023. That's way above the 2% target I was talking about just now. Well, I'd cite a few factors. Spiralling energy costs are a huge one, thanks largely to Russia's war in Ukraine. Supply chain issues lingering from the pandemic, still not being solved in all sorts of areas of the global economy, and of course relatively robust demand built around people spending their pandemic savings perhaps, jobs data being relatively robust, and so on. So inflation has spiralled way above any target that's been set by these central banks, such as the Bank of England. So what can they do in response? And basically they've only got two levers to pull. One is to raise interest rates in the hope of dampening demand, both from businesses and consumers. And the second is to reduce or even reverse quantitative easing, which is the process of printing money in order to buy bonds. Now, here's the problem. You might say, well, why don't they just use those tools and get on with it? If the target's meant to be 2%, inflation's at 10%, why not just crank on with raising interest rates, throwing the QE lever into reverse? Job done. Not quite. Why not? Well, raising rates sharply, for example, raising interest rates sharply, and they've got no choice about this, really. We're seeing record interest rate rises coming through from the Federal Reserve, the Bank of England, as they realise they're behind the curve. Number one, may not work. Why not? Well, if energy costs, for example, are the primary cause of inflation spiralling, how does increasing the cost of your mortgage or a business loan by increasing interest rates affect that? So some people are saying, will it work? Will the lever even do anything? And it could make a recession worse, because clearly if people are facing spiralling household bills, massive hikes in energy costs, bigger mortgage payments, raising rates might simply just tip the economy into recession. And of course, it risks what's called baked-in inflation, or even the nightmare of stagflation, which is increasing inflation, falling growth. And by baked-in inflation, I mean people might start to assume, well, hang on a minute, inflation's here to stay, interest rate rises are inevitable, I want a pay rise, and suddenly you've got a wage inflation spiral, as people call it. So is there a way out of this, what's increasingly becoming a mess in some people's view? Well, first of all, central banks must be hoping that inflation is transitory, that this spike into double figures won't last, And there is some evidence they might be right coming through as I make this video towards the end of the summer 2022. Job data is reasonably robust still. So in terms of getting out of stagflation, if you like, inflation might start to come down. Job data might stay relatively robust, which is a sign that growth might not completely peter out, if you like. But it's a tightrope. I wouldn't want to be a central bank right now. On the one hand, they've got people saying you're behind the curve, you need to get on with raising rates back to their normal level, which is higher than they are now. On the other hand, you've got people saying, but if you move too quickly, you will tip the economy into recession, you will trigger stagflation, and so on. Now, to find out more about a big topic, please do go to our comprehensive video library, killick.com/learn. If you'd like to read a bit more about equity markets, you might ping me for a copy of a guide which isn't sitting next to me, but it's called How to Invest in Equities, and that will be editor@killick.com. And if you'd like to read about some of this stuff in context, for example, commentary from the bonds team here and so on, macro commentary around interest rates and inflation, then do ping me an email, editor@killick.com, to request a copy of our quarterly magazine, Confidant.